while the benefits of a cleaner energy system are huge, so can the disruption to people's lives as we try to get there. So the question is, how are investors managing such risks and opportunities? Well, to find out, you're glad to hear that I won't be telling you. For that, I'm joined by not one, but two experts. Vara, could you please start with introductions?
Sure. My name is Varia, and I'm the lead for Sustainable and Transition Services at Investment and Portfolio Solutions Group at BlackRock.
Thank you. Good to have you with us. And Michael?
Yeah, I'm Michael Ridley. I'm an Executive Director at MSCI, where I lead our fixed income, ESG and climate research group.
Great to have you with us, guys. Great. Varia, could we start with you? What investment opportunity is the transition creating?
Of course. So transition to low carbon economy is going to drive massive reallocations of capital as energy systems get rewired. And we believe that the shape and the speed of transition is going to be informed by three major drivers. The first one being policy, for example, the EU Green Deal or the Inflation Reduction Act in the US. The second one is emergence of new technologies, for example, carbon capture. And finally, the shifts in consumer preferences. What's important to note, though, is that the speed of transition will be very different across different regions and different sectors. For example, developed markets are likely to transition more quickly than emerging markets. Or when it comes to sectors, for example, the electrification of vehicles, of light vehicles, is on track by 2050. But there are also some harder to abate sectors that will require a significant investment and policy changes in order to transition. So all in all this economic rewiring is presenting tremendous opportunities and risks for investors across sectors. For example, if we just take energy sector as an example, we expect that the average investment into the energy sector is going to increase to 4 trillion per year over the next 30 years. And this is much bigger versus 2 trillion that we have observed in years in the past. But it's important to note that it's not just the energy sector story. We will see capital being reallocated across all sectors, low-emitting sectors, high-emitting sectors. And our goal as BlackRock is to equip investors with insights and information in order to capitalize on these opportunities.
Thank you. And Michael, where's the opportunity for you?
Well, as Varia said, it's going to be a very large redistribution of capital. And I have a similar number, which is $4 to $6 trillion per annum expenditure to achieve transition by 2050. Effectively, you decarbonize power generation, and then when you have low carbon electricity, having moved from coal to gas to renewables, you use that throughout the economy. So you use your low carbon electricity in transport EVs and in cooling and heating of buildings. So where is money going to be put to work? Well, further build out of renewables, a lot of money to go into electricity transmission and distribution, energy efficiency, let's not forget that, and then EVs and green buildings. And that's before you begin to look at hard to abate sectors. So a lot of money to put to work.
Good. Okay, Michael. Staying with you, a lot of money being put to work. I mean, how are schemes navigating climate risks and opportunities in their core allocations?
Yeah, sure. So in terms of climate risk, we think of transition and physical risk. So transition risk actually is this risk that if you don't decarbonize, you may be susceptible to policy or high carbon price or regulation or consumer demand that moves against you. So at MSCI, we try to estimate the cost of physical and transition risks for companies using a metric called CVAR, climate value at risk. So that's an estimate of percentage EV hit from climate risk through to 2100 on a company by company basis. If you hold a portfolio, say in fixed income in bonds, we have a metric which is TPF, total portfolio footprinting. It's an estimate at the bond level of how much CO2 per $1 million bond outstanding you have. So it's a way of estimating your portfolio emissions, and then you can see over time if those emissions are falling.
Okay. And Varia, what's your take on how this has been implemented by schemes?
Sure. So when we speak about transition opportunities and risks, it's very important to firstly acknowledge that the definition of transition investing is constantly evolving. And this is why we as BlackRock have come up with a framework around how we think about transition investing, so that it can hopefully support clients in understanding how to think about transition risks and opportunities across the value chain. And the way we define transition investing at BlackRock is in 4 key ways. The first one is assets that are preparing for transition. So a good example of that would be a company that's a leader in the peer group when it comes to decarbonizing of its operations. The second category is assets that are aligning to transition. So these are the assets that are already on a decarbonization pathway that's in line with industry-wide low scenarios. So for example, low carbon scenarios. So for example, EU Paris-aligned benchmarks.
Okay.
The third category is assets that are benefiting from transition. So here think of key inputs that are needed for decarbonization and that will likely benefit from macroeconomic tailwinds as economies around the globe decarbonize. And finally, the fourth category is assets that are contributing to transition. So here think of solutions, for example, wind farms that are really helping the real economy to decarbonize. Now, our goal as BlackRock is to provide investors with choice and customization so that they can pick solutions that align with their transition investing objectives and priorities, which obviously may be very different depending on a client.
Okay, you talk about solutions there, but what about the challenges that schemes are facing when trying to transition their portfolios?
Yeah, there are challenges at every level. So the first challenge is tied to what we've discussed previously, that the speed and shape of transition is likely to be very different across different sectors and regions. And here, the driving force for the shape and the speed of transition is really an interplay of different factors, whether it's government policy, whether it's renewable energy, and investors sometimes underappreciate the speed of transition in different areas. The second challenge is related to investment process. So on a daily basis, investors need to deal with multitude of transition analytics, constantly evolving landscape, and look for products that would, on the one hand, support the investment objectives related to transition, but on the other hand, will be in line with their financial goals as well. And finally, the bigger picture challenge is how do I make my portfolio more resilient to climate risks over the long run? How do I capitalize on all this multitude of investment opportunities across the value chain? And here, as a fiduciary, we invest on clients' behalf in order to help them meet their investment objectives. And our philosophy here is underpinned by 3 main criteria. The first one is choice. The second one is seeking to deliver best risk-adjusted returns for the mandates that clients give us. And the third one is our work being underpinned by research, data, and analytics.
And Michael, what are the challenges for you?
Well, as you heard, in some respects, we like to help clients to distinguish between companies and their transition strategies and journeys. And so the idea is to distinguish between those that will end up as stranded assets and those which are climate change solution providers. I mean, we have a metric called low carbon transition, which applies at the company level, which is one way that we can give information. I think it's also interesting to see the securities that are being issued by companies. So in the bond markets, you can issue a sustainability linked bond or a green bond, and information from these can give the investor guidance on the trajectory of the company in question. I guess the other thing I'd say is actually transition can be quite expensive. So if a company commits to decarbonize, often its balance sheet is the thing that's slowing the journey and sets the pace at which companies can decarbonize. The thing we'd say is actually you don't have to decarbonize all your assets to transition. You can actually sell some of them or close them down. So it's actually sometimes that you have more optionality as a company than many people think to decarbonize.
Okay, thank you. Final question now, Vora. Diversification is imperative for trustees in safeguarding their members' retirement income. But how can they manage that when they're also trying to transition their portfolios at the same time?
Yeah, aligning the portfolio to transition is the whole portfolio affair, and it can really affect all parts of investors' investment process. For example, when they build strategic asset allocations, how do I make my allocation more resilient to climate risks over the long term? How do I select the right products that are aligned with my transition goals? And in general, these transition considerations are affecting the day-to-day investment process of investors. And while every investor and every investment process is very different, there are some commonalities that we observe when it comes to aligning the portfolio towards low carbon transition. For example, we see investors go through 3 phases in this process. The first one is defining portfolios' transition targets and assessing their portfolios against it. So here we see investors select from multiple industry-wide decarbonization frameworks and then using forward-looking analytics to assess whether their portfolio is in line to meet these objectives. The second phase is designing a transition strategy for the portfolio. And this is we, as BlackRock, can support clients with insights and proprietary technology. And here the questions that we hear about most frequently are, which asset classes should I start with when I start transitioning my portfolio? Then how do I make my strategic asset allocation resilient to climate risks over the long run? And finally, which strategies exist that can help me decarbonize my portfolio or capitalize on investment opportunities across the transition value chain, for example, materials, energy, electric vehicles? And how do all these strategies in aggregate affect my portfolio's transition profile, but also financial profile, for example, tracking errors, sector biases, style factor tilts, and so on. And finally, the third phase is monitoring. So aligning the portfolio to transition is never a set and forget approach. So here we support investors monitor if their portfolio is on track to achieve their transition goals and financial goals as well. And if there is some misalignment that we observe, we are providing some actionable guidance to investors as to how they may want to course correct.
Thank you, Ms. Farah. Thank you. Michael, diversity, transition, how can they work?
Well, I think if I understand your question, I would say that it's important to focus on helping reduce transition risk and looking for upside, as opposed to achieving impact. Impact is a separate goal, and I think we're talking about advising investors on getting good returns. And if they focus on reducing transition risk and upside, then that's what should be aimed for. I guess the other thing is advising clients to achieve transition over time in a low-cost way, which can involve less trading. And so we are beginning to talk about a glide path solution in fixed income, which MSCI is happy to talk to clients about.
Thank you. Michael, Vara, thank you very much for your time. Thanks for coming to talk about such an important topic with us today. Thank you.
Thanks so much.